negative 27.67%. Just let that number sink in for a second. We're not here today to look at cherry-picked wins or perfectly curated highlight reels. We are here to document the raw, completely unvarnished reality of automated trading in live market conditions. And then there's this, 65.44%. That is the maximum drawdown this account has weathered so far. It's a staggering figure, really. The kind of number that literally breaks most systems and honestly breaks the psychology of most human traders. These numbers set a clinical, unforgiving baseline for exactly what we're going to examine today. Welcome to this explainer of the GoldMining Swissie Recovery Series. I'm your host, and today we're laying out a cinematic, documentary-style journal tracking the long-term behavior of a live US dollar, Swiss franc, grid, and Martingale expert advisor. Specifically, we're zooming in on week 20 of 2026. Look, this isn't some story about overnight riches. It is a meticulous, ongoing study of recovery, stabilization, and ultimate algorithmic survival.
Section 1. Week 20, Account Status, The Naked Truth.
Let's dive right into exactly where the system stands right now. Notice the absolute transparency here. We are looking at the precise financial standing of this automated system, plain as day. The hard numbers show a current balance of $1,729.21 and an equity sitting just a hair below that at $1,719.60. The heavy burden of that negative 27.67% total growth and that massive historical drawdown, it's etched directly into these metrics. It's a pretty sobering look at the reality of holding on after a deep systemic shock. The grueling journey required just to reach our current status is mapped out clearly. If you trace the lifetime balance versus equity, your eye is naturally going to be drawn to that historic sheer cliff face plunge back in late October 2025. That was the absolute crucible for this system. But since then, look at the long, slow, grinding path of this current rebuilding phase. The balance and the equity are closely hugging each other right now. And that narrow gap is a stark, really vital contrast to the massive separation we saw during the crisis. This is what the cold, hard reality of a long-term recovery phase actually looks like. Section 2. Macro Market Conditions, the Catalyst. Now, to truly understand those micro account metrics, we can't just view the algorithm in a vacuum. We have to look at the potent, heavy mix of global drivers for the USDCHF pair. You've got hawkish Federal Reserve expectations colliding head-on with persistent, stubborn inflation sentiment. When you combine all of that with rising Treasury yields and global capital seeking safe haven positioning, the resulting catalyst is just this relentless, overarching US dollar strength. Let's see exactly how that macroeconomic narrative translates to the actual price action. Looking at the 15-minute time frame, it visually proves the immense pressure the system is navigating right now. There's this uninterrupted, relentless upward trend of the US dollar against the Swiss franc, closing out the session high at 0.78676. When the market trends this aggressively in a single direction without any meaningful pullbacks, grid and Martingale systems are put under intense and, honestly, sometimes fatal stress.
Section 3. EA Defensive Behavior, the Machine's Response.
Which brings us to arguably the most fascinating part of this week's analysis. What's incredibly striking here is what the machine actually chose to not do. We're seeing exactly 0% trading activity and a 0% gain for the week. Confronted with a relentless trending market that completely goes against its core logic, the algorithm adopted a strictly defensive posture. We're documenting a period of significantly lower volatility and intentionally slower equity movement. Basically, the machine analyzed the macro conditions and calculated that the absolute safest move was to just stand completely down. And here is the literal, uncompromising proof of that defensive stand. The History tab for the week is completely, utterly empty. Just a blank screen reading no history data. Now, it is incredibly important to understand something here. This absolute absence of trades is a deliberate, coded feature of algorithmic stabilization. It is absolutely not a flaw. Think about it. A less sophisticated, more aggressive system might have blindly forced trades into that strong upward trend, compounding its risk and practically inviting a margin call. But in this instance, silence is the strategy.
Section 4. Historical Drawdown and Risk, the Philosophy.
To fully appreciate why that silence is so vital, let's re-examine that daunting 65.44% drawdown peak. Notice how the massive downward spike perfectly and aggressively inverts the growth curve, pulling the entire account history into deeply negative territory from which it is still trying to slowly emerge.
This really highlights the brutal, inherent dangers of this system and the immense difficulty of recovering from such deep capital troughs. Surviving a hit like that literally changes the entire operational philosophy of the machine. So, the underlying philosophy we're analyzing today is really a tale of two extremes. On one side, we absolutely must acknowledge the inherent risks of grid and martingale strategies. We're talking terrifyingly deep drawdowns and suffocating margin pressure. But on the exact opposite side, we have the uncompromising discipline required for long-term survival, absolute patience, a total dedication to capital preservation, and strict risk management. This week's flatlined trading activity, that was simply the algorithm choosing capital preservation over forced, highly risky progression. Section 5. Future Outlook. The Road Ahead. The coming market sessions really hold the key to the long-term viability of the GoldMining Swissie accounts. We're closely watching for 3 specific technical indicators to emerge. Number 1. Does aggressive recovery momentum return if the macro trends finally reverse? Number 2. Do we see continued flat stabilization as the EA remains in its defensive crouch? Or number 3, does dangerous, renewed volatility emerge, forcing the system once again to defend its fragile remaining equity? Ultimately, the market is going to dictate the terms, and the machine will simply have to react. As we close the book on week 20, we're left with a rather compelling final thought. In the high-stakes world of algorithmic trading, is the calculated ability to do absolutely nothing actually the most powerful survival trade of all? We document real market conditions honestly, refusing to hide the difficult, stagnant, or painful periods. Real accounts, real risk, real progression.